Hi everybody, and welcome back to the WHVP podcast. In this week's podcast, our topic is ESG investments. We're also going to be talking about the financial principle of diversification. Join us as our team talks about what we got up to on the weekend. Let's get into it. So, we have a very serious day today. It's the day after the 4th of July. It's very sad. I'm glad that both Urs and Jamie came dressed very appropriate to mourn the passing of the 4th of July.
Did you celebrate it?
I was playing rugby all weekend, so no.
Okay.
I mean, in my heart, yes, but I was surrounded by British people, so I just constantly mocked the English monarchy for a whole day, so that's how I celebrated it, in true spirit.
Nice.
Yeah, that was good. What did you guys get up to this weekend?
Well, Julie had an exciting Friday night with the soccer match.
Well, yeah, yes, I am a big fan of football, and I watched the match Switzerland-Spain. And yeah, I was for Spain, not against Switzerland, so that was a bit difficult for me, but at the end I was happy for Spain, yeah, so it was really good.
Which shirt did your son wear? The Swiss one or the Spain one?
No, the Spanish one.
Oh, really?
Yeah. But he had the Swiss one prepared.
Sitting next to him.
Yeah, but he was a bit sad because if Switzerland would have won, then he could have gone tomorrow to watch with all his friends. But now that's not happening, so yeah.
Sad. Yeah, it's crazy. When Switzerland won to get into this game, I could not believe the pandemonium that took place that evening. I'd never experienced such celebrations in Switzerland in my life.
Yeah, I think people are starved for celebration.
Yeah.
Just any reason to be happy and go out into the streets and celebrate something.
Yeah, I mean, when in Usher, we were watching it with my brother-in-law, and just driving like 1 mile to our house took us 20 minutes just to get through the city because all the cars were stopped in the middle of the city. Everyone was on the street. They were on top of the statues in the middle of the roundabouts and just shaking your cars. Hilarious. So I was hoping that was going to happen again. But.
Well, it will happen it happened with the Italians on Saturday, so yeah, and they are still there, so the Italians, they know how to party when they win, so
True.
Yeah.
But they will probably not win.
Yes, definitely they won't.
Don't think. I think they're playing really well.
Yeah, they do, but against Spain, it will be difficult.
Yeah.
But we'll see.
And who else? England and
Denmark.
Mm. Never count out the little guy. Quite cool. So today we're going to talk about ESG investments and what that means. Often, at least I've found while studying finance, you get these abbreviations of different types of investments, and it's always takes a little bit more of reading or understanding to understand what they mean, why they're there. So ESG, just quickly, I mean, we all know, but for our listeners, ESG is environmental, social, and governance. Investments, and that is where investors look at other metrics of a company than just their financial results. So instead of it's the bottom dollar investing, how's the company performing? It's what does the company do for the environment? How does that company treat the social environment that it's in? What do they give back? And then how are they run as a company? Are they ethically run? These are, very small synopsis. So let's get into that topic and share our knowledge on ESG investments and why they're important, or are they important for investing?
I think they are important, but it isn't something very new. So the concept of having this shareholder approach, or where you recognize that there are several groups and social groups that are affected by your work and by the activities of your company, that has existed for a long time already. And during the last century we have seen a lot of discussion about corporate governance, where is the focus on the board and the management, so how do they react, and what are they doing in terms of social work, in terms of how they treat their employees, was always a part, but it was very, very hard for the investors to access this kind of information. And what ESG does with all the new regulation that is coming in, which is more on a soft level, which is not compulsory for the firms, but it gives a framework for the companies to present their information and what they are doing in a way that investors can understand and can research and make informed decisions on top of this information.
Yeah, and I think especially for wealth managers and asset managers, it's important to have a good understanding of ESG. When clients come to you and say, "Hey, I don't want to support, companies that are damaging the environment." Well, we know, okay, through these ESG reports, how is this company acting environmentally? And I think it's a big point you bring up that's really important to know, is a lot of these things aren't compulsory yet. They're coming slowly, regulations coming out, but right now the companies who are bringing this out, it's all voluntary. They realize that they can raise capital with investors, and they want to express their value just outside of the dollar or the possible return, but hey, this is how we impact the world that we're in on a broad scale outside the financial impacts.
Yeah, I agree that I think it's a healthy and a good development that people are more concerned about sustainability in general and ESG more specifically. The issue I'm having a bit with the topic is how broad it is. So, ESG is an umbrella term that, for example, the environmental part could refer to greenhouse emissions, but then the governance part could relate to diversity in a corporate board, for example. So, and those are two extremely different things. And I think people have to be very clear what they're looking for when looking for ESG, and have to be very clear on what they're measuring. And I think there can also be parts of ESG that can enhance performance. So for example, we saw in the past couple of years in a variety of studies that diversity and inclusion enhances the profitability of a company oftentimes. Whereas I think it's also very important to see the approach that you brought up, the shareholder versus stakeholder value approach, maybe briefly explaining for our listeners. So in the past, the focus was more on the shareholder approach, where people said, well, everyone's best off if basically the money is deployed most efficiently so that it yields the highest return to the shareholder. Whereas nowadays some people are leaning more towards the aspect of saying, okay, if we have a stakeholder approach where a company is more looking into the interests of a variety of stakeholders, it's best for the company and the environment in itself. And I think both values have its pros and cons as usual. To round up what I'm trying to say is, I think there are some good aspects in ESG, but I don't think it's like a one-size-fits-all solution where you can just put an ESG label on something and then all the problems are solved. I think it's a good direction that we're going at, but the whole issue with greenwashing should not be discounted too much. So meaning that people just using it basically as a marketing ploy instead of really changing something.
Mm.
Where I'm struggling regarding ESG is that the companies want to get this ESG label, but people just living around, they don't want to pay more. So if you have this ESG level or stamp, then prices will go up, but people don't want to pay that. For example, Ryanair, who has a problem, but they have really low fares. So people don't want to buy more, to pay more for their flights, but they say, yes, we want ESG things and so on. Same we saw here in Switzerland when there was this vote for the CO2, how's it called?
Carbon dioxide.
Yeah. They voted no because they would have to pay more for gasoline, they would have to pay more for the flights, and when it goes into your wallet, then it's no. So that's a bit a contradiction, I think, and that's where I'm struggling with it.
Yeah, I do agree to that point, and what I would add to that is also the question of the comparability, the Wettbewerb, what is the
competitive.
word? It is the competitiveness, because if you regulate everything, it becomes within the time it becomes very difficult to like bring up an additional benefit to make something better than others do. And I think that is what helped many companies in the past, that they could make a difference or could differentiate themselves against other companies by taking into consideration social aspects, by taking into consideration environmental aspects, and by doing so have a more sustainable and long-term approach, which is also one reason why these kind of companies performed better in the past. And when you lift the level so that what they did, the good, I call them the good companies in the past, that this is the new standard, it becomes very hard to go the extra mile again, because at one point of time you are where you want to be, and then you don't have any competitiveness anymore.
Yeah, I agree, and I think we also have to look at, are we giving money to companies who are not doing any active harm, or are we giving money to companies who are actively doing good? Because I do think it's adequate to not invest into companies that are like actively having like an unsustainable business model. I think that's not really very much defensible anymore in this time and age. But at the same time, I think that it's not the first responsibility and priority of a company to actively do good necessarily. So I think to some part yes, but everything that's then the extra mile should be up to the company to see whether that's sustainable for them and their finances or not. And so that very much leads into the point that you brought up, that not everything has to be and should be regulated. And that also leads to the question of whose responsibility it is. And I think as a consumer, we all have a very large responsibility of which companies we're giving money to and what kind of additional price we're willing to pay for something to be sustainable. And I don't, of course, there's some, regulatory responsibilities that governments have, but I don't think that they are the only group that has responsibility, or that they are even the main group. I think consumers, and then also in a second tier, the investor, which is what we're now talking about.
Yeah, I think it's coming back to the competitiveness, and also, Jamie, to tie your point of how broad ESG is in general. I think it should stay deregulated as much as possible for the competitive nature, allowing companies, some companies might be more environmentally focused. Some companies might be more socially focused, or some companies might be very governance focused. You look at Starbucks, a great example, that they're very governance focused as far as their stakeholders, their employees. They really in the States, they really look after their employees, their baristas, their coffee makers. They try to give them enough hours to get them on medical benefits. They focus really well off on the governance side. Some other companies, a lot of companies in the States focus a lot on the social aspect, where they say, hey, we try to make sure all of our employees are spending 20 to 40 hours a year doing volunteer service for whatever products that they set up. And I think that's, as you struggle with it saying so wide, I kind of like that, because it allows us as investors to look in, or what our clients or people want from us to invest, or as personal investors, and say, what do I care about? What motivates me? How do I want to raise capital? And how do I want to impact society that I'm in? And I can go and look, okay, I want to spend an environmental, companies who are really looking for the environment. And so they might get that ESG stamp, and that's where it's good to know, okay, the company has the ESG stamp, but what section are they really focused on, or what do they cover? And I think that that's very valuable. And if they just regulate that and say, yeah, to cover all of it, well, companies, like you mentioned, Jamie, the sustainability of the business profits, we might see those wane in companies go out of business because they can't keep up with all the regulation. So I think I like how wide it is, but I understand the point of, okay, it's a bit frustrating when you see ESG because you don't know exactly what it means. I mean, it can mean so many different things. And at the same point, I like right now that it's not regulated because it allows companies an advantage in raising capital or adding value to themselves through how they act.
Yeah, I really like the point that you brought up that even though a company might have an ESG stamp, you will always have to look into the numbers and the report of the company anyway, because you'll have to see and check for yourself what exactly they do and don't do, because there's also so many different it's not like there's one universally acceptable ESG stamp and then if a company has that, you're good to go. There's a variety of organizations with a variety of standards and levels. So I think, especially as professional investors, but also as private investors, you will always have to double check and see where are they good at and what are they lacking, and is that in alignment with the company philosophy and also with the philosophy of the investor in the end.
Yeah, very good.
Yeah, and I think the danger we have in the current environment is that it will become to a tick-the-box activity.
Yeah.
And I think that should not be the case for the future, because, as you said, all companies are individual in some way, and they may have other focuses which are good and which are which add a value. If everyone does the same, you don't add any further value to the society overall.
Yeah, I think if you're not actively harming the planet or the environment or social factors, whatever, then it's not necessarily the responsibility of the company to actively do something good. I think if a company wants to do that and has a business model that does that, that's great, good for them. But I don't think that a company that doesn't want to or can do that is automatically irrelevant, because a company's main value is to meet the needs of consumers.
Mm-hmm.
And if it does solve a problem for a consumer without specifically hurting the environment, but also without doing any specific good, then that's fine. That might still be a good investment case. That might still be a good company, in my opinion.
Yeah, definitely. I like the point, and I would add that also in regards to the ESG stamp, we have talk about that this gives a new opportunity to investors, because there are a lot of institutional investors. They have to take this into consideration, and as soon as the company doesn't have an ESG stamp anymore, they cannot invest in it. And if you look further into the company, as you said as well, and look what is their activity, what they are trying to achieve, you have the possibility to figure out companies that are in a turnaround and that they will comply with these standards in the future, and that they might be much more active in this regards than the other companies that are already at this point, which again will give you an opportunity against other investors who cannot invest yet, but might invest as soon as they achieve a specific level of ESG.
Yeah.
I think it's a very good point. Now we're going to get into our financial principle. This week's financial principle is going to be diversification on an investing level. So not diversification of the workplace, but diversification of finances of a portfolio. As a principle of finance, what is diversification?
So diversification means that you have a variety of asset classes with a variety of investments with the overall goal to reduce volatility in your portfolio, to get more stability into it, so that you have less extreme outcomes to the positive and to the negative. So when I say asset classes, I mean, for example, stocks, bonds, precious metals, currencies. Not all of them correlate. So, for example, if stock prices go up, gold can go down or vice versa. And adding to that, because this part of diversification, I would say, is mostly known to investors, but there's an additional level to diversification which a lot of people forget, which is our main area of expertise actually, is international diversification in terms of like different financial jurisdictions, because there you can beat home bias, which means if you're an American, you're having an American-based portfolio with an American investment advisor, chances are that you're very heavily invested into the American stock market and the US dollar, whereas if you get into the mix a European or an Asian asset manager, you also have more geographical proximity to other markets and a different kind of expertise, which automatically leads to more diversification because you also have different currencies in the mix, you have different financial jurisdictions adding into the mix, which then overall leads to more stability in your wealth. Very brief.
Yeah,
briefly.
I totally agree, and I would add to this, to all of this, that it is also about reducing the risks. So you talked about volatility, but at the end of the day, it is that you want to keep the risk as low as possible with the best possible outcome you can get in return for that.
Yeah, to go into like the financials a bit more, or like in theory a bit more, so you are rewarded for risk that you're taking when you're investing. So you have a general market risk, and then you have specific company risks. And for the market risk, you are not rewarded because you can diversify it away. So that means you need between 15 and 25 different positions in your portfolio to diversify away market risk. And if you're not doing that, you're basically taking on risk that you're not being rewarded for, which is not really efficient. But having said that, I think another important point that we need to talk about that a lot of people don't really consider is the cost of diversification. So there's cost associated with transactions often, not always, but often. And also there's, depending on the level of wealth, if it's a very small portfolio, having 25 different titles may not really make sense because the positions are then so small that they are almost negligible. So I think we have to weigh diversification versus the costs. But it's certainly something that if it is doable from a cost perspective, that is extremely important.
Yeah, you should never put all your eggs in one basket, because if you believe in one sector and you just buy into this sector, you are really happy when you win, but it is really hard when everything goes down and you don't have any other sector. So I think that's a very important thing, to diversify as best as you can. Yeah.
I think diversification also comes down to the time horizon that you have and the willingness to take risk, because what you just said, if you put everything into one sector that then crashes and you're maybe 70, 75 and you're not working anymore, you have no possibility of getting the money back. If you're at the beginning of your career, if you're maybe in your late 20s or beginning 30s, then you have a lot more time to make up lost money. So I think that the time horizon and the personal situation has to be taken into consideration as well. But with our main clientele, I would say the risk tolerance is smaller or is lower, so their diversification is even more important than for younger people, even though for them it's already important.
Thanks for joining us today on the podcast and our discussion. If you have any more questions about WHVP, feel free to check us out at whvp.ch or check us out at any of our social media handles on Facebook, LinkedIn, or Instagram by searching WHVP. Have a great day.